Hello and welcome to another exciting episode of Africa Business Weekly, your premier source for business and finance news from across the continent. This week's episode promises to be engaging as we bring the latest business news, trends and analysis from East, West and Southern Africa. I'm Aki Obakeye. In this episode, we will unpack a report by the World Bank Group on its international debt and how developing countries performed in foreign debt servicing in 2023. We then turn our attentions to some of the challenges facing women entrepreneurs in the Democratic Republic of Congo and how best to address them. From West Africa, we'll look at a report by the Africa Private Capital Association on private capital investment in Francophone Africa between 2022 and the first half of 2024. But let's get the show started. Karabo Mashaba is on standby for regional updates from South Africa. Hello, Karabo.
Thank you, Akin. This week we spoke to the World Bank about its latest international debt report, which revealed that developing countries spent a record $1.4 trillion to service their foreign debts in 2023. CNBC Africa's Nastasia Arendse caught up with Ehan Kosa, who is the Deputy Chief Economist at the World Bank, for more.
The main message of the report is that developing economies have a huge debt challenge. Of course, the pandemic aggravated that challenge. Things have not improved on the ground, and this challenge has significant consequences for their prospects. Let me make 3 quick points. You mentioned the first one. They spent the highest amount, a record $1.4 trillion, just to service their foreign debt in 2023. This is the highest, we have seen over the past 2 decades. Of course, the higher interest rates made a big difference in the sense that interest payments just on this debt surged nearly a third to more than 400 billion. So what's going on here? That's the second point. When you look at the interest payments of the lower income developing economies, they now amount to nearly 6% of their export earnings, a level we have not seen since 1999. Of course, for some countries, these payments are much, much higher, close to 40% of their export earnings. I think the third important point is credit conditions tightened. The multilateral development banks, the World Bank and other multilateral institutions have become basically the main lifeline for these poorest economies. There, the issue is that private sector creditors, they basically were taking money out of these countries instead of providing net inflows. In contrast, World Bank and other multilateral development banks, they continue to provide net inflows, lending and other types of inflows. So the big picture is the debt service payment is quite high, and that eats up the necessary funding governments need to allocate for fundamental services like health and education, as you mentioned.
I mean, as you mentioned, those debt service costs are looking quite high. Let's go pre-pandemic for a bit. What was the picture like when we look at these debt burdens?
Yeah, before the pandemic, debt burdens were already increasing. There was no question about that. The pandemic, of course, required these countries to increase their spending significantly. When you think about the low-income countries, most of them are in sub-Saharan Africa. The primary deficits tripled to more than 3% of GDP in 2020 when we had the pandemic. Since then, these low-income countries were not able to reduce these primary deficits, so they ended up basically trying to cut the other parts of their budgets because they need to pay the wages, the salaries of government employees, and they need to make the interest rate payments. When you look at government debt in the poorest economies, the Africa, of course, continent has many of these economies. Debt now it stands more than 70%, which is close to 2 decades high. And nearly half of these low-income countries are in what we call debt distress or high risk of falling into debt distress. the picture with respect to pre-pandemic and post-pandemic basically has become much more complex and not in favor of developing economies.
And in more business news shaping up in the Southern African region, CNBC Africa's Palesa Mofokeng spoke to Dorothy Nyambi, who is the president and CEO of Mennonites Economic Development Associates, about Africa's journey to building sustainable systems that will enhance capital flows into the continent. Let's listen in for more.
When we look at the financial sector, it really means where is the money sitting that is being accessed on the continent. Everybody talks about in Africa, we need money, businesses need money so that we can create jobs. And what domiciliation means is that we are able to bring this money, have it be resting here on the continent, to be able to be accessed by small and medium-sized businesses. And that's where the economic engine of growth happens. And that's where the jobs get created. But in addition to that, domiciliation itself, the value chain of domiciliation is a job creator. If you think about other countries where domiciliation happens, they've created so many jobs. So it is really foundational for building a financial system.
Interesting. And Dorothy, what are the key findings then just regarding the state of investment vehicle domiciliation in Africa?
Yeah, some of the key findings, and before I talk about the key findings, I want to just really touch a little bit why the study. Because when we launched the MasterCard Foundation African Growth Fund as a tool and a vehicle for job creation for youth on the African continent, at the time, the assumption was that by requesting investment vehicles to be domiciled in Africa, we're not going to be able to get enough. But what has happened when we launched this study was, instead of looking at it as a roadblock, let's figure out what do we need to do to solve for it so that more investors can domicile in Africa and Africans can domicile in Africa as well. So the findings definitely have to do with 4 key areas. We looked at the area of the enabling environment, the ease of doing business in any of the countries in Africa. That was one of the findings, which we found out was not as easy as the countries where people tend to domicile in. We looked at the regulatory frameworks of these countries and also noticed that it was different from the countries where people prefer to domicile in. We look at the judiciary frameworks, and we also looked at what we call operational efficiencies. And look at those 4 areas, because if somebody needs to domicile their fund, their money, they want to go do it in Luxembourg, they want to do it in Delaware, they want to do it in Cayman Islands. And those were the things that are pushing people to those other areas. So when we did the study, we then looked at 10 countries across Africa, and I won't go into the reasons how they were chosen or why they were chosen, but those were the 4 categories we looked at. And the findings was that compared to other places where jurisdiction is easier, there's a spectrum that we have on the African continent. But this foundation we must build.
But what are these investment vehicles? When I think about the term investment vehicle, it can be broad. Yes. Is it a grant? Is it a loan? Is it a pension fund? Is it a guarantee? What financial instrument do they fall under?
So when we started and we launched the MasterCard Foundation African Growth Fund in March 2022, we deliberately used the term investment vehicle. It could be a fund manager. Okay. It could be a financial institution. It could be a guarantee fund. So it's an intermediary vehicle. But we wanted to open it up to as many different instruments as possible without blocking the door, so that with a range of asset classes, we could reach a wider range of people with access to finance and create as many jobs as possible. So investment vehicle is just the name of how we've decided to call the intermediaries.
And that's all from the Southern African team. It's back to you, Akin.
Many thanks for the updates there, Karabo. Let's now cross over to East Africa for more content from Tabitha Mutoni. Take it away.
This week, East Africa was packed with opportunities, including a transformative UNDP initiative offering African tech entrepreneurs access to $1 billion US. Aimed at supporting 10,000 youth across the continent, this funding is part of the Timbuktoo initiative, which seeks to drive innovation and growth across key sectors. CNBC Africa's Abi Agena sat down with Ahona Eziakonoa, Assistant Secretary General and Director of the UNDP Africa Bureau, to unpack the details and highlight sectors poised for innovation and growth.
We're not going to be able to achieve the development aspirations of the continent unless we invest in a very intentional way in our young people, in particularly our young entrepreneurs and innovators. And this is because, you know, the challenges that we face today in development require technology. We require innovation. We need to be able to go fast and accelerate the development. And young people are the ones who really have the key to accelerating these development solutions through their innovations and their ingenuity. And we've seen this across the continent. So Timbuktoo comes on board really to do three things. One is to facilitate access to capital, because there's a huge shortage of capital for the level of talent and ambition that we're seeing. So we want to be able to crowd in more capital for these young entrepreneurs. Secondly is to fix the fragmented ecosystem. So there is a lot going on everywhere, but there isn't really one place where you are able to converge all the ecosystem support that is needed. So Timbuktoo is also trying to fix that. And thirdly is really connection to the market. You know, a lot of African countries have small markets, big ambitions, but small markets. And yet we have the Africa Continental Free Trade Area. And I think a Timbuktoo initiative that helps expand that opportunity in terms of access to markets is something that we think is going to create a lot of change. So over the next 10 years, the ambition is to raise $1 billion more, if possible, to support 10,000 startups across the continent. We want to be able, through that, to actually scale at least 1,000 of those into gazelles, unicorns, and perhaps elephants, and then through that create livelihood opportunities for up to 100 million people, with a possibility of $10 billion value creation. So it's quite an ambitious initiative, but we've started to test the ground and we can see that it's possible.
Indeed, quite. So building up on this, of course, there's been a huge talk around economic growth for Africa. Perhaps, how do you see Timbuktoo positioning green investments, especially investments that can help to grow the green tech hub that is Africa?
Yeah, first of all, it's really exciting that we just launched the Green Tech Hub here in Nairobi with the President of Kenya. And in this first cohort, we were able to bring 43 founders, enterprise startups to the final stage. They are all here in Nairobi going through the program. And the solutions that they're putting on the table could be potentially groundbreaking in terms of the kind of transformation that we're looking at in Africa's economies. You have enterprises that are looking at bringing new technologies that can influence, say, irrigation for farmers. But one thing that I find really exciting about all of the innovators is that they put at the center of their innovation the importance of accessibility, affordability, and sustainability.
In more business news, despite comprising 41% of the population, women in the Democratic Republic of Congo, DRC, home to nearly 100 million people, face significant gender inequality challenges. Representing 62% of the labor force, particularly in agriculture, their contributions to micro and small enterprises and the informal sector often go unrecognized. I sat down with Elizabeth Kebite-Guth, who is the associate partner at Microsafe Consulting, to gain insights into these challenges, explore barriers to financial access, and also highlight ongoing initiatives working to address them.
The DRC is one of the largest countries in Africa, with almost 100 million of population, and among them we have 41% of women. And as in many other countries, women face discrimination that is noticeable in different domains, especially in the social cultural gaps that restrict women to engage into social life, economic life, and even public decision. And for instance, we have the Gender Inequality Index, which measures the gender disparities in 3 areas between men and women. The areas are the reproductive health, the empowerment, and even the labor market participation. And in the DRC, it was at around 0.6 in 2022, which means that the level of inequalities between men and women is still high in this dimension. Talking about participation of women in the labor sector force, it is estimated at almost 62%. And we can also notice that 69% of women work mostly in the agricultural sector, while among them 20.5% already almost are entrepreneurs. And when we talk about entrepreneurship, it's good to mention that there are 2 different types of entrepreneurs that we can say. There are these small, small businesses, women, that start the business by because they need to earn to make their ends meet, and usually they kind of they can cook food, sell them on the streets, they can resell manufactured goods, or even sometimes they can cross borders to make trades with neighboring countries. And this is the larger part. And the second type, and that has mostly SMEs, and that is this group of women that decide to launch their business, and because they want to scale it and pursue a market opportunity. Usually, women businesses are in the agricultural sectors, as I said, and they are often also, you can also find them in small-scale trading, manufacturing, services, but mostly in the informal sector, because the first type of women that are small is the larger part of entrepreneurs women in the DRC. Talking about SMEs themselves, there is a little existing data. However, there are studies that have shown that in the DRC there are more than 300,000 SMEs. Among them, we have at least 40% of women SMEs. And even there are striking differences, mostly regarding the earning outcomes. Women run businesses perceive 67% lower profits on average than men. And even in the agricultural sector, where we have most women working there, we can notice that women farmers produce less than 18% less revenue than men, and they are even 11% less productive than men. That just shows that there are a lot of challenges in the sector for these women in the DRC.
That's it on Business this week from the East. Back to you, Akin.
Many thanks, Tabitha. We now bring our regional focus back to West Africa. In what seems to be one of the biggest deals in Nigeria's oil and gas industry this year, Seplat Energy has finalized the acquisition of Mobil Producing Nigeria Unlimited from ExxonMobil. Now, this strategic move will surpass Seplat's production capabilities and significantly bolster the nation's energy landscape. This exclusive interview with Roger Brown, CEO of Seplat Energy, gives more details about the deal and the Nigerian energy company's plans for growth.
It's a wonderful day today for us. Seplat's young. We're only a teenager. We're only 14 years old. And this is a truly transformational acquisition for us today, announced. If I look back, I was looking back to why did we go to the market in the first place? Why did we list back in 2014? Our thought piece around that was to be credible, to have visibility in corporate governance, and it raised capital to do an acquisition of scale. And today we've done it, and we're delighted. And what does it mean for us? This is a world-class set of assets, a world-class trained staff that are coming across. 900 are coming across to this. An opportunity for oil development, gas development, and this is very, very critical, not just for us as a group, but also for Nigeria.
Because I'm curious to know how then this translates into profitability for the company and also for shareholder value.
Yes, look, we have a set of assets that have not been worked. In the past that have been, but not recently. So we've got around 600 plus wells, of which only 200 are operating. So we're going to get after those 400, and we will work out which ones we can open up quickly and increase the production. So there's a lot of value upside here initially for what we call in this industry, the low-hanging fruits. Whilst we work out what we're going to do in the longer term, whether drilling with a drill bit, and there's lots of potential with the reserves, a lot of reserves, 409 million barrels of oil equivalent 2P, so that's big. Gas resources are enormous. Somewhere between, our CPR says 5 TCF, but we see numbers in 14 to 15 TCF of gas. So getting after that gas and actually monetizing the gas domestically with domestic projects in Akwa Ibom State and other states close by, and also into export models. Will it be LNG into something like Nigerian LNG or floating LNG opportunities as well? So that is where the real value is here. We've got a workforce who are hungry. They're very, very hungry. They've been sitting there knowing the quality they have, but a shareholder that is deploying money elsewhere in the world, and then you're fighting for capital globally. There's no fight for capital globally for Seplat. Our world is Nigeria, and all the capital comes here.
It's good you mentioned the workforce, because then it brings up the question of integration, because looking at these two powerhouses coming together and talking about people and the culture, I'd like you to speak to that and how you're going with that integration process.
Well, it's wonderful, the synergies we see already. And we've only really had access to the staff only in the last couple of weeks. And I could see the enthusiasm. We had a town hall today. We had a Seplat one separately, and then we had a combined town hall with Seplat, or the Seplat Energy Producing Nigeria Unlimited, which is the new name for MPNU. And I can tell you there was a buzz in the room of the leadership team, and we could see all the facilities around where we operate. There's a real excitement. So there's a synergy already, even before we look at what's the integration. Seplat's very clear on what its culture and strategy is. There's a lot of commonality between the two.
We now shift focus to private capital investment in Francophone Africa. Now, a report by the African Private Capital Association shows that about $900 million was invested in 117 deals between 2022 and the first half of 2024 in Francophone Africa. The first ever report exclusively dedicated to private capital in Francophone Africa shows that Senegal, Cote d'Ivoire, and Rwanda topped the list of countries with the highest deal volume. Nadia Kouassi-Koulibaly, the head of research at the African Private Capital Association, unpacked this report.
We're focusing on Francophone Africa this time because this is one of the regions that are overshadowed historically, even if the region is showing a strong economic performance. We as Africa, being the voice of the private capital activity in Africa, we thought it would be good to shed light on the periphery market on private capital activity, because most of our report cover the big four, what we call the most more mature markets such as Nigeria, Egypt, Kenya, and Southern Africa. But as the voice of the private capital activity, we wanted to showcase also, as I mentioned, the region on the periphery. Hence why we launched our first of a kind Francophone report on private capital activity.
Right, and one of the highlights of the report is rising interest, investor interest, especially being led by Cote d'Ivoire and Senegal. Help us unpack this rising investor interest. What are investors, why the sudden appeal, or why is the appeal for this region rising, and what are the key drivers of that?
The key finding of the report are twofold. So the first one, as I mentioned just before, is a strong economic performance. So as a WEMU countries, including Cote d'Ivoire and Senegal, as you mentioned, are forecasted to grow at 6.8% in 2024, significantly surpassing the continental average of 3.1%. So this performance, showing that the region is ahead of other regions, is definitely attractive for investors. So what we've seen in the last 10 years is a surge of the private capital activity. As I mentioned, although West and Central Africa capture the majority of Francophone Africa's investment activity, the West drove most of the momentum, covering sort of the Francophone West Africa countries attracting $1 billion, reflecting, as I said, a strong and growing investment ecosystem in the region. So, what are the key drivers apart from the strong economic growth? So we've seen a country leadership driven by Cote d'Ivoire and Senegal, who are emerging as a key investment hub on the continent, driving innovation and growth through regulatory advancement. For instance, the introduction of supportive regulation like the Senegal startup back in 2019 and the investment code in Cote d'Ivoire 2018 have played a pivotal role in fostering a favorable investment climate in the Francophone regions. Secondly, so as I mentioned, the strong economic growth is definitely presenting strong opportunity for private capital investors. And last but not least, the regional integration, such as the African Continental Free Trade, is accelerating cross-border investment. This has made the region even more appealing for international investors.
Let's talk about debt. The report also highlights that private debt has also gained traction, accounting for approximately a fifth of both private capital deal volume and deal value over the past 2.5 years. Could you just shed some more light on that for us?
Yes, so in terms of private debt, so as recently the traditional investment strategies such as private equity has slowed down on the continent, we've seen an increase of the private debt specifically from 2018, driven by investment activity in Cote d'Ivoire, for instance, in particular in infrastructure sector and also industrial investment in this country and also in Benin and Senegal.
And it's a wrap on this week's episode of Africa Business Weekly. Special thanks to my colleagues Karabu Mashaba and Tabitha Mutoni for the regional updates. Many thanks for watching. I'm Akin Obakeye. Do enjoy your weekend.